Welcome! Today, we're breaking down borrowing costs in public sector accounting. Governments often borrow to fund projects like schools, highways, or to manage cash flow. These loans come with interest and fees, collectively called borrowing costs. International Public Sector Accounting Standard 5, or Ipsas 5, sets the rules for how these costs are reported. Getting this right is crucial for transparency and public trust. We'll show you when to capitalize borrowing costs, adding them to an asset's value, and when to expense them immediately. Real-world examples and journal entries will make these concepts clear. By the end, you'll know how to identify qualifying assets and apply the correct accounting treatment. Let's get started. So, what exactly are borrowing costs under Ipsas 5? They include not just interest, but also finance charges, loan fees, and even some exchange rate differences. There are two ways to account for these costs. First, you can expense all borrowing costs as they're incurred, simple and direct. Second, you can capitalize them, but only if the funds are used for a qualifying asset, something that takes significant time to get ready, like a bridge or hospital. Capitalizing means adding the interest to the asset's value, not expensing it right away. This choice affects both your surplus and the value of your assets. Capitalized costs are later expensed through depreciation. Entities must apply their chosen policy consistently. Most capitalize borrowing costs for big projects to better match costs with future benefits. Let's see how this works in practice. Imagine a city builds a new sports complex, funded by a $10 million loan at 5% interest. Construction takes 2 years, making it a qualifying asset. In the first year, $500,000 in interest is incurred. Instead of expensing this, the city capitalizes it, adding it to the asset's cost. The construction in progress account grows by $500,000. The journal entry, debit construction in progress, $500,000. Credit cash, $500,000. This continues each year until construction is done. Once complete, the total cost, including capitalized interest, moves to the buildings account. The city then starts depreciating the asset over its useful life. This approach spreads the cost over the years the community benefits from the complex. Now, let's look at expensing borrowing costs. This applies when loans fund routine operations, not long-term assets. For example, a health department borrows $2 million at 4% to cover salaries and supplies for 6 months. The $40,000 interest is expensed immediately. The journal entry, debit borrowing costs. Expense $40,000, credit interest payable $40,000. This reduces the year's surplus and accurately reflects operational costs. No asset is created or enhanced, just a clear record of the cost of borrowing for day-to-day needs. This method matches costs to the period in which the funds are used. It's straightforward and ensures transparency in reporting. Ipsas 5 sets clear rules for when to start and stop capitalizing borrowing costs. Capitalization begins only when 3 conditions are met. Spending on the asset has started, borrowing costs are being incurred, and project activities are underway. If construction is delayed, interest before work starts must be expensed. Capitalization pauses during long project suspensions, like legal disputes or major delays. Short breaks or ongoing admin work don't require suspension. Capitalization ends when the asset is ready for use, even if minor tasks remain. After that, any further interest is expensed. These rules prevent overcapitalizing and ensure costs are matched to actual project progress. Professional judgment is key, but the standards guidance keeps reporting consistent. Let's see how this applies in a more complex scenario. Often, public entities use one loan for multiple purposes. Suppose a regional authority borrows $20 million at 6%. $15 million funds a new hospital wing, a qualifying asset. $5 million covers operations. Ipsas 5 requires splitting the interest, capitalize the portion for the hospital, expense the rest. Total interest, $1.2 million. Capitalize $900,000, $15 million x 6%. Expense $300,000, $5 million x 6%. The journal entry, debit construction in progress, $900,000. Debit borrowing costs. Expense $300,000. Credit cash, $1.2 million. This ensures costs are allocated based on how funds are used. Accurate allocation is crucial for compliance and transparency. Mixed-use loans are common, so this method is essential for real-world public sector accounting. Always document your calculations and rationale. Now, let's wrap up with key takeaways and disclosure requirements. Ipsas 5 also requires clear disclosures in financial statements. Entities must state their policy. Do they capitalize or expense borrowing costs? If capitalizing, disclose the total amount and the capitalization rate used. This helps users understand the impact on asset values and reported surplus. The key is distinguishing qualifying assets from routine expenditures. Capitalize borrowing costs for major projects. Expense them for operations. Start capitalizing only when all conditions are met. Suspend during long delays and stop when the asset is ready. For mixed-use loans, allocate interest carefully. Following these rules ensures transparency, compliance, and public trust. Thanks for watching. Now you're ready to master borrowing costs in the public sector. If you found this video helpful, please like and subscribe for more public sector accounting tips.